Hey guys, David Robinson here. Welcome to the apartment investing journey. Another week, another great guest, and I'm excited to have Scott Choppin on the show with us today. Scott, welcome to the show.
Great to be here, David. Thanks for the invite.
Yeah, my pleasure, my pleasure. So a little bit about Scott. He's the CEO and founder of the Urban Pacific Group of companies, a Long Beach, California-based real estate development company. He founded it in 2000. It focuses exclusively on workforce housing communities throughout California and the Western United States. Urban Pacific has created a new housing innovation called urban townhousing, which pairs private capital with middle-income, multi-generational rental housing while producing market superior yields on invested equity. And he's got a great track record of success in this space. And I'm excited. Scott and I were chatting a little bit before we hit record here. And I think he's going to have some value to share with us in the development space and particularly with this product type that many of us may not be, experienced in or familiar with, but it's always great to have guests that have unique skill sets and specialties. And so I'm excited to get into our story. Scott, you've been in this business for a long time, 35 years in the development space. You've been on many other podcasts. You've been featured in, with Forbes magazine, Globe Street, Los Angeles Times. So look, you've got a lot to share with our audience, but we want to get the whole journey. And so if you don't mind, let's back up a little ways and talk to us about this journey that you've been on over the last 35 years. Where did it start for you?
Yeah, as you say, 35 years starts to sound like a really long time, which is fine. Good and bad, good and bad. I had a family background. Actually, my uncle Mike and my dad Kerry were both real estate developers in their own right. And so when I was young, I got the amazing opportunity to be exposed to that, not necessarily knowing how to do it, like, technically and from a knowledge standpoint, but I knew what a developer did, or at least I thought I did. But, the idea of, finding a piece of land, developing it, like building buildings, like when I was young, that's how I thought about it. When I was 18, I actually went in and worked in the trades for like just a handful of years. And at that point in time, I was doing a lot of reading. I was, working in construction, and I had this epiphany. In fact, I read a book that basically is like your basic, invest in real estate on the weekends type of book. And what was noteworthy about that book is that book enlightened me to deal making, what I call deal making. In other words, the old saws, buy low, sell high, buy low, add value, and increase value and then sell it. And so that was sort of at the time I got, oh, I see. So like build buildings, be a developer. And then here's the core of the deal, the heart of the deal of financing, creating value, and then, producing profitability. And so from that point, on, I went back to, quit doing construction, got into the college track, graduated with a finance degree, and then ended up purposely seeking and finding, early career building jobs. Particularly, I worked for a subsidiary of Kaufman & Broad called Kaufman & Broad Multi-Housing Group. That was an apartment development company that was a subsidiary of what people now know as KB Home, like one of the big, national home building companies. But this division only did apartments. And I got the most killer education in being a real estate developer. And one of the things I'll share with you, David, is I really think of investing and development as very distinct. For many years, I sort of, mashed those together. But if like several years ago, I was like, it's interesting. Although we invest in our own deals and we hold the assets in many cases, sometimes we sell them, we're really not an investor in the way that people think of classically. Like we don't buy existing assets, we always develop. So, when I look back on it in that 35 years, one sort of noteworthy thing is I've always been a developer, like from like the earliest time that I was thinking about a career plan. That's all I've ever been. But then also my running joke is when people are seasoned entrepreneurs and they have capital events and they sell their companies, magically many people want to become real estate developers. It's like sort of a sexy thing to do, right? Like, oh, right. I got all this money, now I'm going to go be a real estate developer. Of course, in many cases, what they lack is the actual knowledge of how to do development, which in many cases, people who are seasoned investors know this about development, right? Like I was on Michael Blanc's podcast, and at the end, when we finished recording, he goes, "Yeah, Scott, I've looked at development. I've thought about development. I'm not doing it. It scares the heck out of me." and I said, I get it, right? It's
Yeah.
like it's a whole domain of politics and design and like entitlements that are not like related to investing. So, anyways, fast forward 21 years ago, I founded Urban Pacific. In fact, this year was our 21st year in March. And we've been basically doing development that entire time with a specific focus on urban infill projects, meaning building new apartment and residential projects in already existing neighborhoods and cities and city centers. And then in the last 5 years, we created this urban townhouse product that you referenced in the intro as a specific offer in the workforce housing space, like something that was uncommon, a lot less competition, a way to generate, great profits, and also pair that with serving middle income families. So we sort of have the social impact, working together with this, in fact, the way I say it is we're pairing private capital with a workforce housing model. So we're really, we don't do any other projects. We used to do other different kinds of residential projects, but we believe so firmly in this category, both in the impact of helping families, but also the demand is huge, the need is huge, the supply is low, and we're based in California, which we're the most radically supply constrained marketplace in the United States. So
Right.
It's definitely needed here.
Well, I appreciate you giving us that overview, and I want to dive into a few aspects of it. The first is I'm curious about when you started Urban Pacific 21 years ago. So roughly, 2000 or so.
Yeah. Mm-hmm.
You probably had a ramp up period. You're in the development space. You already have you had this education working with the multi-housing group that you're working with. And then we ramp up 5-7 years and all of a sudden the market shifts. So I most of my multifamily investing friends and colleagues and associates that don't have an interest in development look at development as high risk, right? So I'm interested in hearing about your journey as it relates to that time in the market cycle, and how did that work out for you? How did you navigate it, and what should people know about development as we are potentially at the top or on the back end of a new market cycle?
Yeah. And you're talking about the formation in like 2000, or are you talking about
just the ramp up period through, I'm assuming things went great, but I'm curious about your experience in that 2005, 6, 7, maybe even 8 range, and how you navigated that world.
Yeah, amen to that. Those are both great questions. Well, the ramp up period. So I talk a lot about like entrepreneurship in real estate development. Like one of the things, if people go to our website and look at the articles that I write, I do talk about, career building, like if you want to, get into the real estate development business, or if you want to start, doing deals. And so really in the beginning, there's several different ways that you can facilitate the ramp up, as you call it. And I appreciate that distinction. And, like several different ways. So I'll just sort of jump into them. So in the early years, we did a lot of joint venture work, right? So we're a small company. I was, I think, 32 at the time. So, I was seasoned, but I wasn't seasoned in the way that like investors and lenders would necessarily look at, most favorably. And so what you look at as, and in fact, this is what I love about Michael Blanc's, his whole, structure is, do that first deal, but do it in a way that, can be successful. And that usually is pairing up with somebody else. So I think of networks, that could be a JV with another developer. That could be, a partnership with somebody who knows how to do development. But I think the reality is to get the first deal done, or the first group of deals done, in a way that you don't make such a monumental mistake then that you're then out of the business. And so I think probably some of the people that you described, they're scared of development. They've heard these stories. Oh, this dude, he did this development deal and it went haywire, and he lost, all the investment that he put in there. Like that's a
Right.
classic story.
Yeah.
And so by joint venturing with people that have knowledge and resources and background in development, you can like watch them, you can work with them, you can use their resources. So you may find the deal, bring it to this partnership, this joint venture, and do it that way. So we did actually a lot of that. In fact, I'll offer this, the company that I left, Kaufman and Broad, Mike Costa ran the division at the time. I went back to them and said, hey, I've got these deals. I mean, they, in fact, in a way, knew my skill set, because almost all of what I learned was, learned with them or from them.
Yeah.
So I went back, and I think we ended up doing 3 major apartment deals of different types, where basically they brought the equity. They did the loan guarantees. Like these are the, any investor or developer, these are the friction points, right? I got to find that equity. Oh, well, you don't have any track record, so I don't want to invest with you, which is a fair assessment, right? If you're a sophisticated investor, you don't want to be,
right.
and I want to be investing in your learning process,
right.
and potentially lose money. But the loan guarantees are really, like, to me, that still, we've been doing this a long time. Loan guarantees are like one of the most challenging parts of any deal. And I think in the investment world, a lot of times, because lenders are lending against an existing asset, the story is like simpler, easier.
Yeah.
Oh, I've got this existing asset. It's got cash flow. Maybe it's got some issues. We're going to address those, value add, or maybe it's just a straight purchase. I'm going to own it for several years. So that asset exists, gets people comfortable, lenders, equity investors, the sponsors themselves. But development is like, oh, I'm buying a raw piece of land with nothing on it, and I'm going to build a new building, and then I'm going to lease those units. And so it is more speculative. But the reality is, David, when you know how to do development, those scary things become more manageable, or a different way to say is you're more expert at managing the risk of those additional risk factors in a way that like reduces risk. Now, it is a risky business inherently. So we don't avoid that. So joint ventures, partnerships, and I'm not a big advocate of being business partners in an entity with other people.
Sure.
Like, not that way, but I go, hey, my company is going to pair up with your company. You don't own any part of my company, but we share ownership in this deal. That's how I mean joint venture. And other things, find a mentor. Invite them in. Hey, I found this deal. Maybe you can do it. Maybe they just add track record. Maybe they are an equity investor. Maybe you find an investor that says, hey, I like the deal. I'm going to give you a majority share of that. But I want your track record, your relationships, your networks, your expertise. I'm going to run the deal. Like, I'm the sponsor speaking this to this, mentor partner. But like, a lot of it is like, I spent several years working for other people on purpose, because I felt instinctively that I wanted to be, taught in a professional environment that was only development. Like, there was no investment. I mean, there was investment in the deals that we did, but not like, we weren't like just going to buy investment deals. So that's another way. That's like the long road. But that's also the best, that's the best teacher. You're going to learn on somebody else's dime, arguably. And so anyway, so that answers the first part of the question. Do you want me to
I appreciate
talk
that
about the GFC part of it?
Yeah. Talk about the, that time in the market where the market shifted, and how does a developer navigate that? I mean, I have friends that got caught in that time frame, and then I have others that navigated it just fine. So I'm curious on, what your experience was like and what you learned during that time that we might be able to take away.
Yeah. So, that 2003 to 2006 era, I mean, it was like on fire, right? Anybody who's been in that era, I mean, it was just like, rocket fuel. We actually, at the time, I was partnered with another person inside of Urban Pacific. Like, we jointly ran the company together. And so we took on like a number of condo projects, which one of the lessons that I learned is, like, I have a background in apartment development, And that's really, if I look at my track record and what I'm most interested in and what I'm best at, it's in investing in apartment deals. Now, that 2003 to 2006 era, 2005 to 2008, however you want to put it, it was hard to do apartment deals, right? The condo guys and the for sale guys were just, they could pay a lot of money. The prices were going up, and that's happening now, right? We're seeing anecdotally, like a similar uptick in it, although we have different, circumstances economically now than then. So we took on a lot of that. And then a noteworthy, I remember so from like 2005, 2006, we had like 2 or 3 projects that were condo projects in and around LA, Los Angeles County. And we were pre-selling them. And it was just like, you put it out on the email, our list of potential buyers, and everything would get bought up, like on paper, like we weren't releasing units actually for sale yet, but we were pre-selling them. And then I remember in October of 2006, we did a release on one of our deals, and we got not a single offer to purchase, not a single acceptance. Like, wow. Like, so I remember going to the sales group that we work with, and I go, like, is the email system broken? Right? Like, is there something wrong with the technology? Right. They go, yeah, we thought about that. We checked that, but no, it's working fine. And, the people got the emails. And so it was like really at that time that it finally became like clear that there was something really wrong with the market, right? Like it had turned. And then really, the sort of like a rolling train wreck from like end of 2006, 2007, and then 2008, obviously the world blew up. So, what you do at the time is you do everything that you can to manage the, like, whatever the new situation is. I mean, and that's development, right? In a nutshell, is you're always going to be challenged with new situations, new economics, new part of the economic cycle. Like right now we're dealing with cost inflation, right? Like in the build process, lumber was like way up, as you've heard. And then now it's like, gone down, dramatically. So you're presented with these. So part of it becomes, and this is the lessons I learned from that 2008 era, is how to manage that risk. So I talked earlier about like the development cycle can be risk mitigated. But a lot of it becomes like stuff that you do real early in the development process, right? In your underwriting of the deals, in the deals that you select, the partners that you have, the vendors that you use. And so now my entire philosophy is all oriented around what I call the reduction of complexity in the development process. In fact, my saying is complexity is the enemy of profits in the development cycle, right? So anything that complicates your deal, now they are complicated inherently. I'm not meaning they're not complicated, right? To use bad grammar, but you will start to pick things and underwrite in a way that you start to take that complexity away, right? So as an example, one of the strategies that we implemented in the beginning years of the UTH process is we only bought sites that were zoned. We didn't want to take any entitlements on. And we have really, actually, my career, I've done tons of entitlement work, and we do some now on a limited basis. But we just said, hey, look, this is a way that we can reduce complexity. We just don't do sites that require entitlements. So we avoid the political process, we avoid neighborhood, controversy.
Does that cut out margin in the deal?
It doesn't. No, in fact, I like exactly like I said, complexity increases profitability because it increases the assurance that the project will go more or less in the way that you plan it to, right? Like in the development, and this happens in investment, but no one likes surprises, right? And the reason they don't like surprises is because usually that's going to cost them time, energy, or most importantly, money, right? To your point, margins. And so what it does do is it increases the challenge of finding those sites. And so you have to be much more selective. And so I may look at 50 sites and I find 5 that are good. Whereas if you were less discerning, maybe you could look at 50 sites and half of them work, right? And so it's all probabilistic, right? Confidence level does this particular site work well? Some of their criteria, we want flat square sites. Any developers like listen to this and go, of course, like that's just so obvious. But, I talked to people, somebody called me and they wanted some advice. And so they go, hey, dude, I'm having trouble on this deal. And so I just, I spent a few minutes to talk. So he showed me the site, and it was like a really small apartment complex in LA, but it was built on this crazy slope. And he
Mm.
had retaining walls. And I go, oh, dude, right. Like right off the bat, I looked at it 1 second when I, got the Google Street View, and I go, that's why you're over
Yeah.
budget and you're slow. And I said to him, like, hey, in the future, don't do those slope sites. Yeah, you could, yeah, it's available. And there's more of those slope sites,
Hmm.
comparatively to flat square sites. But there's a challenge there that I just basically anymore. I mean, we're so brutally like willing to decline or quit potential sites, like just done.
Sure.
No, 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 no. In fact, my acquisition team, like, I drive crazy because we're so picky. But what ends up happening is the sites that do make it through that filtering process, I mean, I'm not saying they're all like, viable
Sure.
at the end of the day, but we're just immediately reducing the complexity because we
Mm.
don't choose the complicated site. My running joke was, when I worked for other companies in the beginning, when I was a young project manager, like, my philosophy was like, dude, I can do any deal. Like, I'm such a great problem solver. And I didn't talk this way. Like,
Sure.
I'm not a,
Sure.
like, but I was like, I was really, oh yeah, I can make this work. And I got this site. And so, like, I would get sent a site and I would go to work on it, trying to problem solve it, because that's just my nature. And a lot of times you could problem solve it. The problem was the problem solving of the complicating factor reduced profits and slowed you
Mm.
down, and added risk into it. Right. So now what I go is, no, I'm going to still apply that problem solving process, but I'm going to do it on a site that's more like, less complex and more straightforward. So it increases profitability is the short answer to your question, because you're reducing time constraint, you're reducing the mistakes that cost you profitability. Now, that's nothing to do with the market cycle and valuations and process, but our design of our project type, meaning this middle income workforce housing using private capital, in itself is inherently protective relative to the economic cycle, because we're renting to middle income working families, which is
Hmm.
one of the most underserved demographics in really the United States, but particularly in Southern California. And importantly, these families are multi-earner. And what that does, David, is that gives the capability in a recessionary environment. What ends up happening is families tend to actually, circle the wagons is one of the, colloquialisms I use. But, these families, because they have multi-earners, they sort of get in a defensive mode. And somebody loses a
Right.
job, other earners make up the difference. And so they're much more stable. They're much more able to sustain their lifestyle. And importantly, they're incredibly stable renters. And so when we pick
Mm.
that family type to rent, and then we go into recession, we can know and we can anticipate that they will generally, because they're multi-earner structure, be sticking around, right? Versus,
Mm.
like, I'll give you the example of the opposite. Let's say you have a Gen Z or millennial young person, single earner, lives in a 1 bedroom or a studio, right? Well, as soon as they lose their job, they're out. They have no income. Like, they're
Mm.
they're going to be out. And I'm not saying that that's bad. Like, they're not bad inherently. That's just, they're in a different part of their life cycle. They can go back home and live with parents. They could
Right.
obviously get roommates, but the reality is, for my unit, if I'm renting a studio to them, they're going to be challenged in a way that they just can't produce money from nowhere. Where these families, because they have multiple earners, the terminology is economic sharing, they're much more able to sort of shift and deal with the economic instability in a much more powerful way. And they're both equally valid. Like, these people are good people
Hmm.
in either of these demographic groups. I just say I choose to rent to the families because, one, I like the social, like, I have a family, you have a family. We're oriented to that, and I want to help those people. But also economically, they're a good choice of renters because they have this multi-earner structure.
Well, that's a great segue. And before we, started the episode, you and I were chatting a little bit about this urban townhouse concept. Obviously, you just made the argument for it. Is there anything unique about the construction that lends to this demographic in the way that you're building these projects?
Like, physically building, or do you mean
Yeah.
the design?
Both. I'd be as you think about these multi-generational, tenants.
Yep.
Is there anything unique about the way that you design and construct these projects that appeal to that tenant base?
Yeah. So yeah, no, great. Appreciate the question. So there's different answers for each domain of construction and design. So let me start with design. So, we talked a little bit earlier. So our urban townhouse product is a 3-story, 5-bedroom, 4-bath rental townhome with a 2-car direct access garage. And
Mm,
that design is like incredibly unique and directly serving these families, right? Like, I mean, how many apartment units have 5 bedrooms? Like
right.
practically none. There's a little bit of here and there. 4 bathrooms, right? I mean, you have a family, you have 4 kids, I have 3. Bathrooms are like a constraint, if everybody's trying to get to school and work in the morning, right? Like bathrooms. So, but more importantly is, in fact, the way I described in the early years is it's designed and built to rent, but lives like a house.
Mm,
And that's really really one of the core things is that if you're a family of 6, you got mom and dad, you got grandparent, maybe adult children, maybe young children, and you want to go out and basically find a unit that serves your family best. You look at the development marketplace, and particularly the new construction marketplace, there's like nothing. Like
mm,
everybody's building 1-bedroom studio, maybe a little bit of 2-bedroom, and all that development marketplace is serving that Gen Z and millennial. And that's appropriate because, guess what? That's the largest demographic cohort in US history is millennials, right? But it's also the most competitive space for development, right? Everybody's
sure.
doing it, right? And everybody's in that space. There's a lot of big players, Trammell Crow, Holland Partners. And if you're a smaller mid-sized company and you're competing with these big guys, I mean, they're going to own you. Like cost of capital is lower, financial capacity, relationships with, capital, their ability, like in a downturn, this is where I went with it. The ability of in a downturn for Trammell Crow to lower their rents on any particular project is way going to outstrip my capability to lower rents also and sustain, the financial loss over time. I mean, they'll just lower rents until they rent the units and they'll just operate it that way because they have the financial capacity to do that. So I just said, look, I don't want to compete there.
Hmm.
I will go where they're not, right? And this workforce housing space is literally where almost no one is. Yet the demand characteristics, as I described earlier, are huge. We're in the process of raising capital for a fund, and we did a study with a group called the Conquer Group, and their calculation for demand in this 5-bedroom apartment space is 30,000 units. That's actually 32,000 units just in LA and Orange
Mm,
County demand. In other words, families that would like to live in these units, the demand is 32,000 units of depth of demand. I mean, we could build for the rest of my career and never get close to that. And so, the pool is incredibly deep. Anyways, I'm getting off track here. Let me
no.
make sure I get back to your question.
Yeah, I was curious, and you touched on this a little bit
Oh,
about the
sorry.
design and the construction that
Right.
that
So,
lends itself to this multi-generational tenant.
I talked about the design. I think, we spent enough time there. The construction actually is that we build really one unit type. So we're like a production home building operation. In fact, our
Mm,
construction operations are all in-house. We don't use third-party GCs. So we have our own project managers, our own field managers. We have our own subcontractor base. We operate very much like any home builder would in any particular market, except we're building these townhouse projects, right? But the design is like the most simplified,
mm,
basic production. The technology, I mean, if you looked at it, David, like we're using nothing. Like you wouldn't. I mean, we're in California, so we have like a higher standard of energy efficiencies and all that kind of
right.
thing, right? But we just manage through that. But you look at the construction. I mean, it's the most basic thing. I mean, obviously
Mm,
stick built on grade, but again, in this idea of reducing complexity. So a lot of projects in the new development space right now are higher density. So think 3 or 4 or 5 stories over an underground parking structure, either above grade or below grade, called a podium project. We just said we're not doing podiums because the
hmm.
complexity and the friction in the process of building those, I mean, appropriate when the economics are good, appropriate when the market cycle is good. But you really have to be on your game to execute. So we just said, look, we'll just build the most simple townhome possible. And that's 3 stories. So it's not like a 2-story house, but it's as close as we can. And the way we thght of it is we're
Hmm.
at the intersection of the simplest, lowest cost build that produces the highest income or rental income for the economics of the deal. And we think
Mm.
3-story townhouses are the right way to do it. Because if you went up in density, you could produce more units per unit, but or per land area, but it's more costly and complicated to build that, right? If you went
Mm.
up, if you went down in density and built single family house, well, those are really easy. Build a single story single family house, like the most basic, except I lose rent. Like my
Right.
rent, my ability to create income in that is limited because I'm got less density and that kind of thing. So there's sort of this like shifting, and we think the sweet spot is a 3-story rental townhouse in California. Now, if you went to another market, let's say you went to Texas or Arizona or the Southeast, most of the build to rent market is single family detached, like subdivision style houses. Well, the reason they can do that is because land is cheaper. Maybe the construction is cheaper. I mean, we're in California. We're the most like overregulated environment in
Right.
the entire United States, even more so than New York. We're like taking on every new environmental, high energy net zero. And I'm not like against that, but I do make the assessment that it does drive up costs. So like this year in
Yeah.
California in 2020, last year, I should say, we now have to actually install solar installations for every apartment unit. It actually
Hmm.
has to, you can't just put a conduit for future solar. You actually have to install the inverter, put the solar panels on
Interesting.
the roof. And they just said, hey, for 2020, every apartment project, every residential unit that's built new in California has to have the solar actually installed. You can't plan for
Interesting.
it. You got to actually install it. And, rough estimates anywhere between, 5 to 20,000 a door just to install that solar. And they just like one year, you added $5,000. I think right now we're running at $5,000 a door is what our solar contractors are telling us on our apartment units. And I like the story of it, right? It helps the tenants,
Sure.
reduces the load on the grid, all that kind of thing. But if I'm going to serve these families at the lowest possible rent that I can achieve and still be profitable and still produce a return, then any additive cost to that's going to, erode that profitability. And so I either have to increase rents, or do something to offset that cost. And we'll be fine. I'm not like, it's not going to break any deal. But when you do it 50 times or 100 times and you add each of these things over time, I can't remember the stat, but they said something in California, it's like 100 to 125,000. I'm going off memory of cost of regulation added to the housing price or cost of building the unit. Well, there's no way around that. You got to make up for the
Right.
economics of that cost load as a developer. And obviously sometimes deals become unprofitable, right? Or unprofitable, and you don't do it, right? But anyways, I'll stop there. So
No,
the
that's
design
great.
is like as simple and low complexity as we can make it.
And these are built to rent. You mentioned that a few different times. I'm curious about deal structure and what the long term game plan is with these type of projects. What's the hold period? If we get out 10 years, what does that look like for you? I'm just curious about how you structure your deals.
So the capital stack is really simple. I mean, we're generally underwriting 75-25 debt to equity. So of 100%, we're using 75% LTC debt, pretty standard stuff, 25% equity. So like the capital stack is really vanilla. The hold periods, we've actually changed our philosophy over the years, the 5 years that we've been developing this. So in the early years, because we were in that experimental phase that we described, which was the early set of deals were small and medium size on purpose, so we could execute and understand and learn lessons, at lower risk, meaning smaller projects, quicker to execute, that kind of thing. And so we made it through those first four deals. We ended up producing, I think, a 23.06 IRR over about a 2-year investment window on that initial portfolio of 4 projects. And we sold all those, right, on purpose because we didn't know if we wanted to hold them or not. About 3 years ago now, I started to basically sense that we were getting to the end of an economic cycle. This is when in the news we started to hear, longest economic expansion in US history. We're coming up on 10 years. And from the 2008 era, I really, one of the lessons I learned was to really pay attention to the signal and the noise, right? In other words, there's a lot of, it's going up, it's going down. Everybody's got a different opinion about it. And in 2008, I was listening to the wrong people, like, sort of mainstream media and, CNBC.
Sure.
So now what I've done over the years is I've really cultivated a group of economic, prognosticators and people who write and, different ways to track the economic cycle. So we started to hear these signals. And one of my signals is, oh, it's going to go forever. Right. I remember in 2007, they go, oh, housing prices haven't gone down in 30 years. There's like a graph in the Wall Street Journal. And you look at that and you go, my God, this is amazing. That's exactly the signal. Like, hey, trouble's coming, man. Right. When people go, oh, it's different this time. Oh, it's, in 2001 in the internet era, it was, oh, companies don't need to be profitable. The technology makes them different. So economic principles are suspended. Like that's not correct. Right. So people get into that. I call it peak market thinking, right? Like it's so good. It's going to go on forever. And I can keep increasing prices under my underwriting or increasing rent assumptions or whatever. Right. And so now it's to look at the signal and noise. So anyways, about 3 years ago, I started to sense this. And then after that, the yield curve went inverted just for a little bit. That's usually a signal of coming recession. Now, nobody could have known 2020 was coming. I mean, it was the black swan of black swans.
Sure.
But what it did do is it basically, the point of this is that it oriented us differently. We go, okay, something's coming. And so what we did is we converted all of our deals to long-term hold, because my logic was, if these families are sticky, if they're stable multi-earner families, and their jobs are close by and their families close by and their kids are in school and their churches down the road, they're going to stick around. They're not going anywhere. They're solid, stable renters. And I know in going into recession, they will continue to be stable. Then I then switch to a long-term hold structure, and then I can ride the recession out. Because what I did see in the apartment business in 2003, 2004, 2005, people were buying apartments, paying a ton of money, and people were, like, you're overpaying, you're paying. But then the values decreased in 2008. But then when you look at the long-term increase from 2008 to now, or even to 2020, 2019, the upside was huge, right? And of course, we can't assume that the upside will always be that way. But I'm very much in the story that if you're in supply-constrained marketplace like California is, because of our political environment, it's hard to develop deals. But if you can do it and you can own those assets and your restricted supply over the years, that's going to be accretive to your long run values. And so everything's now long-term hold. In fact, I referenced earlier, we're raising an equity fund for that exact purpose. It'll be a 7-year fund, because we basically want to own everything we develop. We want to own for the long term. And in fact, my personal philosophy is I want to own these forever. And the logic is two-part. One, we're deeply supply constrained in the most supply constrained marketplace in the United States. Politically, it's going to take decades for us to dig ourselves out of the political hole that we've developed from a regulatory standpoint over the years. We're starting to reverse that, but it's going to take a very long time. And then just from a philosophical standpoint, from my own, values, my own ethics, standards of conduct for myself, the idea of like helping these families and being a long-term, source of help by stable ownership and developing these assets, like that from a philosophical standpoint, is incredibly powerful to me. So we're, long-term oriented, developers and holders.
Well, I appreciate you going into some detail about, this is a niche product in what I would call, a niche market, so to say. You're looking at a very specific need to fill that market, and you tested the product out early on. You figured out that you can make this work, at 23% IRR on those initial projects. Not going to complain about that. And then shifted your focus a little bit to, from for sale to for rent. And I love what you're doing. The concept makes sense on a high level. And I appreciate going into detail, because a lot of us that are in this space, in the multifamily space, really are, have our heads down and focused on existing value add and learning about development and how it works and some of the advantages to development as well are all good for us to understand and be more well versed in. So I appreciate you taking some time to do that. And I want to be respectful of your time. And so I want to wind down here a little bit.
Sure.
In doing so, I've got a few final questions for you. The first is, you've been in this business for a long time and you've had your own firm for quite some time now. What is the biggest win that you've had on this investing, or let's call it a development journey that you've been on so far?
Really this, I'm not like trying to, overly focus on UTH, but the UTH product to me is the most powerful innovation that we've ever created in this space, right? Like we've always been a niche player. Urban infill was a niche, residential in downtown areas was a niche. But it was always in the context of we were sort of like competing in the wider market. And this UTH sort of is a culmination of all the knowledge that I've gained, all the capability to assess risk and mitigate it, all the networks of people that I have around me. I mean, that's why we're basically not going to do anything else. I mean, I'll do this UTH model for the rest of my career. And, I don't, have an assessment of how long I have, but,
sure.
I'll probably be one of those guys that works, as long as I can work. But it really has been, and particularly through the pandemic, that was a real worrisome spot in the development and investment space for multifamily. Like, are people going to pay rent? We got eviction moratoriums, right? Those kind of things. And this product actually not only performed well, like it's stable and sustainable, but we actually accelerated because families needed this housing more than they ever needed it. And I couldn't have known that would, I knew in a recessionary environment that the recombination of families was a distinct move. Like that happened in 2007, 2009. It's going to happen again and start to happen. But for us to accelerate in that, that damaged cycle part of the economic cycle in 2020 was a real eye opener. I go, okay, we anticipated that this would happen, but we didn't know it would. And so to watch it actually happen, I mean, we had rents increasing, we had high velocity, leasing. There's a book called Anti-Fragile by a guy named Nassim Taleb. And, the logic behind that is to design companies and other structures that actually benefit from harm, right? Like they're actually strengthened by harm. The example I use is, when you lift weights, you damage the muscle and then the muscle repair builds the muscle stronger, right? That's an example of anti-fragile, right? So the idea is to create business organizations, structures, teams, networks that are capable of not only surviving, damage, but even if you can think of the innovation of it to accelerate in a harming period. Now, it's not easy. People may think I sound flip about it, but I literally, this is the first time I've ever had the experience of something that we created to watch it go through a down economic cycle and watch it perform. And so all the things I've learned from 2008, plus all the knowledge acquisition over this, my entire career and my entire adult life. And I work to study this, by the way. I study business knowledge, with several groups that I work with in a way that we challenge ourselves and they challenge me and I challenge them to create these structures that are, competitive, strategic, effective, anti-fragile. So over the last probably 10 years, I've done a lot of work, right? And guess what 10 years is post 2008 to now, right? That's that 10-year period. I mean, 2008 was a huge wake up for everybody, including myself. But now we can start to see that. So anyways, that was a long answer to your question.
No, that's great. That's I love it. The last question I have for you is, what's the best advice that you would have for someone who's just starting their real estate investing or development journey?
So, I would offer this. If people want to go to my LinkedIn profile, it's just Scott Choppin on LinkedIn. There's articles in my profile. One of them is called 6 Ways to Build Your Real Estate Development Career. People can go look at that there. But, the answers I'm giving you here. So some of the stuff I've talked about, so, do joint ventures in your early deals, work with others so you reduce risk and increase knowledge acquisition, vis-a-vis, Michael Blanc, find people that you can pair up with mentors or, coaches, advisors, right? So that you can come into the new deal realizing that you're insufficient, your knowledge isn't enough, your resources, your capital, whatever, and you pair up with people to help you with that. Some of the things would be, for people that want to get into it, like work a job that is in that space or get an internship. In fact, we do regular internships every year. I probably have, now probably 2 or 3 interns each year. I have had several people that were interns with us, like maybe had no real estate experience. And through our internship, they basically launched. One guy particularly is now like he's a full-time professional development project manager. Now he had specific career aspirations to do that, but that's like very powerful. Like the things you need to learn, and this is maybe more development than investment, but I think they're similar in some ways, is you just got to get exposure to the process. You got exposure to underwriting deals. So you got to, whatever it is that you can do to accelerate that. So I'll give you an example in the investment space. I had a guy approach me, he's like in the marketing space. And so we cut a deal. He goes, hey, I'll help you with marketing, think like website building and SEO and that kind of stuff. And I want you to teach me real estate. And he had expressed specific interest in investing. So my advice to him was go out and underwrite 100 deals. Don't intentionally, like, you're not going to do the deals. You're just going to, here's a deal, underwrite it, talk to the broker, go out and assess the rents, walk the project if you can, build a pro forma, underwrite in the pro forma, figure out if you can see what the, value add costs are going to be, assess what the values will be, and do that 100 times. And I promise you, by the time, probably not even, you don't even need to get to 100, you will know the market so well, and you'll have seen really good deals and really bad deals, that you can then, when you now find that good deal, you can take it to that JV partner or to that somebody who's got the capital, and you actually present them a good deal. Because, in the early phases, I mean, this, David, I mean, you like, everybody's so anxious to do deals, they'll do any deal, even bad deals, right? That's a common like move you make. People are so anxious. Those who are self-selected, ambitious, entrepreneurial, they're so anxious to do a deal. And I know this because I'm this way. I was this way, that you will sort of like skip over important parts of things that you probably should look at and go, oh, that deal doesn't work. You're like, sort of jamming the deal. If you like are disciplined enough to underwrite 100 deals, then you will know the market really well. You'll know how to underwrite deals really well. You'll know rents, you'll know operating expenses. You'll have built relationships with the brokers, right? Because you're going to be the guy who's calling on every deal. Hey, what's this? What's that? Now the brokers will know you're a newbie, except after the 50th deal. Now you're not the newbie. Dude, you're calling me a lot, right? Yeah. So when you bring that deal to the JV partner, you actually will say, dude, I know this market really well. And they'll ask you, well, what? And you go, oh, I know this market. I know this neighborhood. Here's the rents here. Here's our operating expenses here. I've looked at all these deals. And now after the 101st deal, this is the right deal. And then you'll have actually support and evidence and knowledge to be able to actually demonstrate to that JV partner, because no JV partner wants a junky deal. They'll tell, in fact, a good JV partner will tell you, no, dude, that deal doesn't work. Don't do it. Like, I've done that. People bring me deals. I go, no, sorry. It's harsh, but it's reality, right? And the reality of being successful is you got to decline junky deals. That's one of your first skills you have to build. Well, how do you do that? You got to know what a junky deal is. So anyways, that's an example.
Love it. Love it. Well, Scott, I've really enjoyed our conversation. It's good to have someone like you with a tremendous amount of experience in a niche market, would call it niche, that we're less familiar with. And so I appreciate you sharing your knowledge and your journey and talking to us about Urban Pacific's, this urban townhouse, the UTH product that you've developed and are having great success with. The last question I would have for you before we sort of close out is, what's the best way for our listeners to connect with you, learn more about Urban Pacific and this product that you're working on and have been having success with? What's the best way for people to connect with you?
Yeah, I would invite people to go to our website. It's www.urbanpacific.com. There's several things to look at there, but there's a whole investor education section in there, videos. A lot of the podcasts that we're on are on there, articles. And they'll sort of be like assessing underwriting as an investor or some of this career development stuff that we've talked about today. But there's a ton of stuff in there, particularly people that are like thinking about or actually transitioning from investing to development. Like that's a real that there's a gap there in knowledge that I've sort of like, tried to fill in. So go there. And then when you're there, there's a red button on any page says sign up. Click there and sign up for this will get you on our list for a Saturday e-blast or email blast. And what I do is I curate, several articles each week of things that the signal from the noise concept that I described, of different things that we're seeing. And it's not just about housing, although it's housing and real estate centric, but it's, economic cycle, it's, new trends, talking about cost inflation. So it's all relevant to investing or development in the residential space. And then sometimes it's just stuff that's exciting, new trends. I shared an article of, 3D printed houses, right? Where they're, extruding concrete to build houses. And, that's sort of exciting stuff. So it's literally what I'm reading on a weekly basis. And I probably am reading, probably 20 to 30 articles a week. Most of it's not relevant to what people would find, interesting and, valuable, right? Like I'm trying to put out, so it's like the curated best of breed from that. And then a lot of times we'll put in something there of just, like our own thinking and the own stuff that we're working on, just sharing out into the marketplace, what we're working on. So sign up for that.
Love it.
And then a contact page is on there and all of our email addresses on there so people can email us.
Perfect. We'll have that in the show notes. So if you're listening right now and you've liked the conversation that we've had with Scott today, go click on that link, connect with Scott and his team. And Scott, again, thank you for your time. Thanks for sharing your journey with us. And I look forward to connecting with you again soon.
Yeah, thanks, David. Appreciate it.